Chapter 1. Investment versus Speculation. Results to be expected by the intelligent investor. This chapter will outline the viewpoints that will be set forth in the remainder of the book. In particular, we wish to develop at the outset our concept of appropriate portfolio policy for the individual non-professional investor. Investment versus speculation. What do we mean by investor? Throughout this book, the term will be used in contradistinction to speculator. As far back as 1934, in our textbook, Security Analysis, we attempted a precise formulation of the difference between the two, as follows. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. While we have clung tenaciously to this definition over the ensuing 38 years, it is worthwhile noting the radical changes that have occurred in the use of the term investor during this period. After the great market decline of 1929 to 1932, all common stocks were widely regarded as speculative by nature. A leading authority stated flatly that only bonds could be bought for investment. Thus, we had then to defend our definition against the charge that it gave too wide scope to the concept of investment. Now our concern is of the opposite sort. We must prevent our readers from accepting the common jargon which applies the term investor to anybody and everybody in the stock market. In our last edition, we cited the following headline of a front-page article of our leading financial journal in June 1962.
In October 1970, the same journal had an editorial critical of what it called reckless investors, who this time were rushing in on the buying side. These quotations well illustrate the confusion that has been dominant for many years in the use of the words investment and speculation. Think of our suggested definition of investment given above and compare it with the sale of a few shares of stock by an inexperienced member of the public who does not even own what he is selling and has some largely emotional conviction that he will be able to buy them back at a much lower price. It is not irrelevant to point out that when the 1962 article appeared, the market had already experienced a decline of major size and was now getting ready for an even greater upswing. It was about as poor a time as possible for selling short. In a more general sense, the later used phrase reckless investors could be regarded as a laughable contradiction in terms, something like spendthrift misers, were this misuse of language not so mischievous. The newspaper employed the word investor in these instances because, in the easy language of Wall Street, everyone who buys or sells a security has become an investor, regardless of what he buys or for what purpose or at what price or whether for cash or on margin. Compare this with the attitude of the public toward common stocks in 1948, when over 90% of those queried expressed themselves as opposed to the purchase of common stocks. About half gave as the reason not safe, a gamble, and about half the reason not familiar with. It is indeed ironical,
though not surprising, that common stock purchases of all kinds were quite generally regarded as highly speculative or risky, at a time when they were selling on a most attractive basis and due soon to begin their greatest advance in history. Conversely, the very fact they had advanced to what were undoubtedly dangerous levels, as judged by past experience, later transformed them into investments, and the entire stock-buying public into investors. The distinction between investment and speculation in common stocks has always been a useful one, and its disappearance is a cause for concern. We have often said that Wall Street, as an institution, would be well advised to reinstate this distinction and to emphasize it in all its dealings with the public. Otherwise, the stock exchanges may someday be blamed for heavy speculative losses, which those who suffered them had not been properly warned against. Ironically, once more, much of the recent financial embarrassment of some stock exchange firms seems to have come from the inclusion of speculative common stocks in their own capital funds. We trust that the reader of this book will gain a reasonably clear idea of the risks that are inherent in common stock commitments, risks which are inseparable from the opportunities of profit that they offer, and both of which must be allowed for in the investor's calculations. What we have just said indicates that there may no longer be such a thing as a Simon Pure investment policy comprising representative common stocks, in the sense that one can always wait to buy them at a price that involves no risk of a market or quotational loss large enough to be disquieting. In most periods, the investor must recognize the existence of a speculative factor in his common stock holdings. It is his task to keep this component within minor limits, and to be prepared financially and psychologically for adverse results that may be of short or long duration. 2 paragraphs should be added about stock speculation per se, as distinguished from the speculative component now inherent,
averaging 18.7% annually. In a fascinating echo of that early Fed survey, a poll conducted by Businessweek at year-end 2002 found that only 24% of investors were willing to invest more in their mutual funds or stock portfolios, down from 47% just 3 years earlier. In most representative common stocks, outright speculation is neither illegal, immoral, nor, for most people, fattening to the pocketbook. More than that, some speculation is necessary and unavoidable, for in many common stock situations, there are substantial possibilities of both profit and loss, and the risks therein must be assumed by someone. There is intelligent speculation as there is intelligent investing, but there are many ways in which speculation may be unintelligent. Of these, the foremost are 1. Speculating when you think you are investing, 2. Speculating seriously instead of as a pastime when you lack proper knowledge and skill for it, and 3. Risking more money in speculation than you can afford to lose. In our conservative view, every non-professional who operates on margin should recognize that he is ipso facto speculating, and it is his broker's duty so to advise him. And everyone who buys a so-called hot common stock issue or makes a purchase in any way similar thereto is either speculating or gambling. Speculation is always fascinating, and it can be a lot of fun while you are ahead of the game. If you want to try your luck at it, put aside a portion, the smaller the better, of your capital in a separate fund for this purpose. Never add more money to this account just because the market is going up, or average down by investing more money if you've had a bad experience. You should never speculate with more than the portion of your capital you have set aside. A margin account enables you to buy stocks using money you borrow from the brokerage firm. By investing with borrowed money, you make more when your stocks go up, but you can be wiped out when they go down. The collateral for the loan is the value of the investments in your account, so you must put up more money if that value falls below the amount you borrowed. Market has gone up and profits are rolling in. That's the time to think of taking money out of your speculative fund. Never mingle your speculative and investment operations in the same account, nor in any part of your thinking. Results to be expected by the defensive investor. We have already defined the defensive investor as one interested chiefly in safety plus freedom from bother. In general, what course should he follow, and what return can he expect under average normal conditions, if such conditions really exist? To answer these questions, we shall consider first what we wrote on the subject 7 years ago, next what significant changes have occurred since then in the underlying factors governing the investor's expectable return, and finally, what he should do and what he should expect under present-day, early 1972 conditions. 1. What we said 6 years ago. We recommended that the investor divide his holdings between high-grade bonds and leading common stocks, that the proportion held in bonds be never less than 25% or more than 75%, with the converse being necessarily true for the common stock component.
that his simplest choice would be to maintain a 50-50 proportion between the two, with adjustments to restore the equality when market developments had disturbed it by as much as, say, 5%. As an alternative policy, he might choose to reduce his common stock component to 25% if he felt the market was dangerously high, and conversely to advance it toward the maximum of 75% if he felt that a decline in stock prices was making them increasingly attractive. In 1965, the investor could obtain about 4.5% on high-grade taxable bonds and 3.5% on good tax-free bonds. The dividend return on leading common stocks, with the DJIA at 892, was only about 3.2%. This fact and others suggested caution. We implied that, at normal levels of the market, the investor should be able to obtain an initial dividend return between 30.5% and 4.5% on his stock purchases, to which should be added a steady increase in underlying value and in the normal market price of a representative
stock list of about the same amount, giving a return from dividends and appreciation combined of about 74% per year. The half-and-half division between bonds and stocks would yield about 6% before income tax. We added that the stock component should carry a fair degree of protection against a loss of purchasing power caused by large-scale inflation. It should be pointed out that the above arithmetic indicated expectation of a much lower rate of advance in the stock market than had been realized between 1949 and 1964. That rate had averaged a good deal better than 10% for listed stocks as a whole, and it was quite generally regarded as a sort of guarantee that similarly satisfactory results could be counted on in the future. Few people were willing to consider seriously the possibility that the high rate of advance in the past means that stock prices are now too high, and hence that the wonderful results since 1949 would imply not very good but bad results for the future. 2. What has happened since 1964? The major change since 1964 has been the rise in interest rates on first-grade bonds to record high levels, although there has since been a considerable recovery from the lowest prices of 1970. The obtainable return on good corporate issues is now about 7.5% and even more against 4.5% in 1964. In the meantime, the dividend return on DJIA-type stocks had a fair advance also during the market decline of 1969-70. But, as we write, with the Dow at 900, it is less than 3.5% against 3.2% at the end of 1964. The change in going interest rates produced a maximum decline of about 38% in the market price of medium-term, say 20-year bonds during this period. There is a paradoxical aspect to these developments. In 1964, we discussed at length the possibility that the price of stocks might be too high and subject ultimately to a serious decline. But we did not consider specifically the possibility that the same might happen to the price of high-grade bonds. Neither did anyone else that we know of. We did warn on page 90 that a long-term bond may vary widely in price in response to changes in interest rates. In the light of what has since happened, we think that this warning, with attendant examples, was insufficiently stressed. For the fact is that the unprecedented rise in bond interest rates added losers by millions of individuals to the usual number of stock market casualties during the 1969-70 decline.
If the investor had a given sum in the DJIA at its closing price of $874 in 1964, he would have had a small profit thereon in late 1971. Even at the lowest level, $631, in 1970, his indicated loss would have been less than that shown on good long-term bonds. On the other hand, if he had confined his bond-type investments to U.S. savings bonds, short-term corporate issues, or savings accounts, he would have had no loss in market value of his principal during this period, and he would have enjoyed a higher income return than was offered by good stocks.
It turned out, therefore, that true cash equivalents proved to be better investments in 1964 than common stocks, in spite of the inflation experience that, in theory, should have favored stocks over cash. The decline in quoted principal value of good longer-term bonds was due to developments in the money market, an abstruse area which ordinarily does not have an important bearing on the investment policy of individuals. This is just another of an endless series of experiences over time that have demonstrated that the future of security prices is never predictable. Almost always bonds have fluctuated much less than stock prices, and investors generally could buy good bonds of any maturity without having to worry about changes in their market value. There were a few exceptions to this rule, and the period after 1964 proved to be one of them. We shall have more to say about change in bond prices in a later chapter. 3. Expectations and policy in late 1971 and early 1972. Toward the end of 1971, it was possible to obtain 8% taxable interest on good medium-term corporate bonds and 5.7% tax-free on good state or municipal securities. In the shorter-term field, the investor could realize about 6% on U.S. government issues due in 5 years. In the latter case, the buyer need not be concerned about. Read Graham's sentence again, and note what this greatest of investing experts is saying. The future of security prices is never predictable. And as you read ahead in the book, notice how everything else Graham tells you is designed to help you grapple with that truth. Since you cannot predict the behavior of the markets, you must learn how to predict and control your own behavior. A possible loss in market value, since he is sure of full repayment, including the 6% interest return at the end of a comparatively short holding period. The DJIA at its recurrent price level of 900 in 1971 yields only 3.5%. Let us assume that now, as in the past, the basic policy decision to be made is how to divide the fund between high-grade bonds, or other so-called cash equivalents, and leading DJIA-type stocks. What course should the investor follow under present conditions if we have no strong reason to predict either a significant upward or a significant downward movement for some time in the future? First, let us point out that if there is no serious adverse change, the defensive investor should be able to count on the current 3.5% dividend return on his stocks, and also on an average annual appreciation of about 4%. As we shall explain, later this appreciation is based essentially on the reinvestment by the various companies of a corresponding amount annually out of undistributed profits. On a before-tax basis, the combined return of his stocks would then average, say, 7.5%, somewhat less than his interest on high-grade bonds. On an after-tax basis, the average return on stocks would work out at some 5.3%. This would be about the same as is now obtainable on good tax-free medium-term bonds. These expectations are much less favorable for stocks against bonds than they were in our 1964 analysis. That conclusion follows inevitably from the basic fact that bond yields have gone up much more than stock yields since 1964. We must never lose sight. How well did Graham's forecast pan out? At first blush, it seems very well. From the beginning of 1972 through the end of 1981, stocks earned an annual average return of 6.5%. Graham did not specify the time period for his forecast, but it's plausible to assume that he was thinking of a 10-year time horizon. However, inflation raged at 8.6% annually over this period, eating up the entire gain that stocks produced. In this section of his chapter, Graham is summarizing what is known as the Gordon equation, which essentially holds that the stock market's future return is the sum of the current dividend yield plus expected earnings growth. With a dividend yield of just under 2% in early 2003 and long-term earnings growth of around 2%, plus inflation at a bit over 2%, a future average annual return of roughly 6% is plausible. See the commentary on Chapter 3. are much better protected and therefore more certain than the dividends of the fact that the interest and principal payments on good bonds, dividends, and price appreciation on stocks. Consequently, we are forced to the conclusion that now we are toward the end of 1971, bond investment appears clearly preferable to stock investment. If we could be sure that this conclusion is right, we would have to advise the defensive investor to put all his money in bonds and none in common stocks until the current yield relationship changes significantly in favor of stocks. But of course, we cannot be certain that bonds will work out better than stocks from today's levels. The reader will immediately think of the inflation factor as a potent reason on the other side. In the next chapter, we shall argue that our considerable experience with inflation in the United States during this century would not support the choice of stocks against bonds at present differentials in yield. But there is always the possibility, though we consider it remote, of an accelerating inflation, which in one way or another would have to make stock equities preferable to bonds, payable in a fixed amount of dollars. There is the alternative possibility, which we also consider highly unlikely, that American business will become so profitable without stepped-up inflation as to justify a large increase in common stock values in the next few years. Finally, there is the more familiar possibility that we shall witness another great speculative rise in the stock market without a real justification in the underlying values. Any of these reasons, and perhaps others we haven't thought of, might cause the investor to regret a 100% concentration on bonds even at their more favorable yield levels. Hence, after this foreshortened discussion of the major considerations, we once again enunciate the same basic compromise policy. Since 1997, when Treasury inflation-protected securities, or TIPS, were introduced, stocks have no longer been the automatically superior choice for investors who expect inflation to increase. TIPS, unlike other bonds, rise in value if the consumer price index goes up, effectively immunizing the investor from losing money after inflation. Stocks carry no such guarantee and, in fact, are a relatively poor hedge against high rates of inflation. For more details, see the commentary to Chapter 2.
For defensive investors, namely that at all times they have a significant part of their funds in bond-type holdings and a significant part also in equities. It is still true that they may choose between maintaining a simple 50-50 division between the two components, or a ratio, dependent on their judgment, varying between a minimum of 25% and a maximum of 75% of either. We shall give our more detailed view of these alternative policies in a later chapter. Since at present the overall return envisaged from common stocks is nearly the same as that from bonds, the presently expectable return, including growth of stock values, for the investor would change little regardless of how he divides his fund between the two components. As calculated above, the aggregate return from both parts should be about 7.8% before taxes or 5.5% on a tax-free or estimated tax-paid basis. A return of this order is appreciably higher than that realized by the typical conservative investor over most of the long-term past. It may not seem attractive in relation to the 14% or so return shown by common stocks during the 20 years of the predominantly bull market after 1949. But it should be remembered that between 1949 and 1969, the price of the DJIA had advanced more than five-fold, while its earnings and dividends had about doubled. Hence, the greater part of the impressive market record for that period was based on a change in investors' and speculators' attitudes rather than in underlying corporate values. To that extent, it might well be called a bootstrap operation. In discussing the common stock portfolio of the defensive investor, we have spoken only of leading issues of the type included in the 30 components of the Dow Jones Industrial Average. We've done this for convenience, and not to imply that these 30 issues alone are suitable for purchase by him. Actually, there are many other companies of quality equal to or excelling the average of the Dow Jones list, and these would include a host of public utilities which have a separate Dow Jones average to represent them. But today, the most widely available alternatives to the Dow Jones Industrial Average are the Standard & Poor's 500 Stock Index, the S&P, and the Wilshire 5000 Index.
The S&P focuses on 500 large, well-known companies that make up roughly 70% of the total value of the U.S. equity market. The Wilshire 5000 follows the returns of nearly every significant publicly.
The major point here is that the defensive investor's overall results are not likely to be decisively different from one diversified or representative list than from another. Or, more accurately, that neither he nor his advisors could predict with certainty whatever differences would ultimately develop. It is true that the art of skillful or shrewd investment is supposed to lie particularly in the selection of issues that will give better results than the general market. For reasons to be developed elsewhere, we are skeptical of the ability of defensive investors generally to get better than average results, which in fact would mean to beat their own overall performance. Our skepticism extends to the management of large funds by experts. Let us illustrate our point by an example that at first may seem to prove the opposite. Between December 1960 and December 1970, the DJIA advanced from 616 to 839, or 36%. But in the same period, the much larger Standard & Poor's weighted index of 500 stocks rose from 58.11 to 92.15, or 58%. Obviously, the second group had proved a better buy than the first. But who would have been so rash as to predict in 1960 that what seemed like a miscellaneous assortment of all sorts of common stocks would definitely outperform the aristocratic 30 tyrants of the Dow? All this proves, we insist, that only rarely can one make dependable predictions about price changes, absolute or relative. We shall repeat here without apology, for the warning cannot be given too often, that the investor cannot hope for better than average results by buying new offerings or hot issues of any sort, meaning thereby those recommended for a quick profit. The contrary is almost certain to be true in the long run. The defensive investor must confine himself to the shares of important companies with a long record of profitable operations and in strong financial condition. Any security analyst worth his salt could make such stock in America, roughly 6,700 in all. But since the largest companies account for most of the total value of the index, the return of the Wilshire 5000 is usually quite similar to that of the S&P 500. Several low-cost mutual funds enable investors to hold the stocks in these indexes as a single convenient portfolio. See Chapter 9. See pages 363 to 366 and pages 376 to 380. For greater detail, see Chapter 6. A list. Aggressive investors may buy other types of common stocks, but they should be on a definitely attractive basis, as established by intelligent analysis. To conclude this section, let us mention briefly 3 supplementary concepts or practices for the defensive investor. The first is the purchase of the shares of well-established investment funds as an alternative to creating his own common stock portfolio. He might also utilize one of the common trust funds, or commingled funds, operated by trust companies and banks in many states, or, if his funds are substantial, use the services of a recognized investment counsel firm. This will give him professional administration of his investment program along standard lines. The third is the device of dollar-cost averaging, which means simply that the practitioner invests in common stocks the same number of dollars each month or each quarter. In this way, he buys more shares when the market is low than when it is high, and he is likely to end up with a satisfactory overall price for all his holdings. Strictly speaking, this method is an application of a broader approach known as formula investing. The latter was already alluded to in our suggestion that the investor may vary his holdings of common stocks between the 25% minimum and the 75% maximum, in inverse relationship to the action of the market. These ideas have merit for the defensive investor, and they will be discussed more amply in later chapters. Results to be expected by the aggressive investor.
Our enterprising security buyer, of course, will desire and expect to attain better overall results than his defensive or passive companion. But first, he must make sure that his results will not be worse. It is no difficult trick to bring a great deal of energy, study, and native ability into Wall Street and to end up with losses instead of profits. These virtues, if channeled in the wrong directions, become indistinguishable from handicaps. Thus, it is most essential that the enterprising investor start with a clear conception as to. For more advice on well-established investment funds, see Chapter 9. Professional administration by a recognized investment counsel firm is discussed in Chapter 10. Dollar-cost averaging is explained in Chapter 5.
Which courses of action offer reasonable chances of success and which do not? First, let us consider several ways in which investors and speculators generally have endeavored to obtain better than average results. These include 1. Trading in the market. This usually means buying stocks when the market has been advancing and selling them after it has turned downward. The stocks selected are likely to be among those which have been behaving better than the market average. A small number of professionals frequently engage in short selling. Here, they will sell issues they do not own, but borrow through the established mechanism of the stock exchanges. Their object is to benefit from a subsequent decline in the price of these issues by buying them back at a price lower than they sold them for. As our quotation from the Wall Street Journal on page 19 indicates, even small investors, perish the term, sometimes try their unskilled hand at short selling. Number 2, short-term selectivity. This means buying stocks of companies which are reporting or expected to report increased earnings, or for which some other favorable development is anticipated. Number 3, long-term selectivity. Here, the usual emphasis is on an excellent record of past growth, which is considered likely to continue in the future. In some cases also, the investor may choose companies which have not yet shown impressive results but are expected to establish a high earning power later. Such companies belong frequently in some technological area, e.g. computers, drugs, electronics, and they often are developing new processes or products that are deemed to be especially promising. We have already expressed a negative view about the investor's overall chances of success in these areas of activity. The first we have ruled out on both theoretical and realistic grounds from the domain of investment. Stock trading is not an operation which, on thorough analysis, offers safety of principle and a satisfactory return. More will be said on stock trading in a later chapter. See Chapter 8.
In his endeavor to select the most promising stocks, either for the near term or the longer future, the investor faces obstacles of two kinds. The first stemming from human fallibility, and the second from the nature of his competition. He may be wrong in his estimate of the future, or even if he is right, the current market price may already fully reflect what he is anticipating. In the area of near-term selectivity, the current year's results of the company are generally common property on Wall Street. Next year's results, to the extent they are predictable, are already being carefully considered. Hence, the investor who selects issues chiefly on the basis of this year's superior results or on what he is told he may expect for next year is likely to find that others have done the same thing for the same reason. In choosing stocks for their long-term prospects, the investor's handicaps are basically the same. The possibility of outright error in the prediction, which we illustrated by our airlines example on page 6, is no doubt greater than when dealing with near-term earnings. Because the experts frequently go astray in such forecasts, it is theoretically possible for an investor to benefit greatly by making correct predictions when Wall Street as a whole is making incorrect ones. But that is only theoretical. How many enterprising investors could count on having the acumen or prophetic gift to beat the professional analysts at their favorite game of estimating long-term future earnings? We are thus led to the following logical, if disconcerting, conclusion. To enjoy a reasonable chance for continued better-than-average results, the investor must follow policies which are 1. Inherently sound and promising, and 2. Not popular on Wall Street. Are there any such policies available for the enterprising investor? In theory, once again, the answer should be yes, and there are broad reasons to think that the answer should be affirmative in practice as well. Everyone knows that speculative stock movements are carried too far in both directions, frequently in the general market and at all times in at least some of the individual issues. Furthermore, a common stock may be undervalued because of lack of interest or unjustified popular prejudice. We can go further and assert that in an astonishingly large proportion of the trading in common stocks, those engaged therein don't appear to know, in polite terms, one part of their anatomy from another.
Discrepancies between price and value. Thus, it seems that any intelligent person with a good head for figures should have a veritable picnic on Wall Street, battening off other people's foolishness. So it seems, but somehow it doesn't work out that simply. Buying a neglected and therefore undervalued issue for profit generally proves a protracted and patience-trying experience. And selling short a too popular and therefore overvalued issue is apt to be a test not only of one's courage and stamina, but also of the depth of one's pocketbook. The principle is sound, its successful application is not impossible, but it is distinctly not an easy art to master. There is also a fairly wide group of special situations, which over many years could be counted on to bring a nice annual return of 20% or better, with a minimum of overall risk to those who knew their way around in this field. They include intersecurity arbitrages, payouts or workouts in liquidations, protected hedges of certain kinds. The most typical case is a projected merger or acquisition, which offers a substantially higher value for certain shares than their price on the date of the announcement. The number of such deals increased greatly in recent years, and it should have been a highly profitable period for the cognoscenti. But with the multiplication of merger announcements came a multiplication of obstacles to mergers and of deals that didn't go through. Quite a few individual losses were thus realized in these once reliable operations. Perhaps, too, the overall rate of profit was diminished by too much competition. In selling short or shorting a stock, you make a bet that its share price will go down, not up. Shorting is a three-step process. First, you borrow shares from someone who owns them. Then, you immediately sell the borrowed shares. Finally, you replace them with shares you buy later. If the stock drops, you will be able to buy your replacement shares at a lower price. The difference between the price at which you sold your borrowed shares and the price you paid for the replacement shares is your gross profit, reduced by dividend or interest charges, along with brokerage costs. However, if the stock goes up in price instead of down, your potential loss is unlimited, making short sales unacceptably speculative for most individual investors. In the late 1980s, as hostile corporate takeovers and leveraged buyouts multiplied, the lessened profitability of these special situations appears one manifestation of a kind of self-destructive process, akin to the law of diminishing returns, which is developed during the lifetime of this book. In 1949, we could present a study of stock market fluctuations over the preceding 75 years, which supported a formula based on earnings and current interest rates for determining a level to buy the DJIA below its central or intrinsic value and to sell out above such value. It was an application of the governing maxim of the Rothschilds: buy cheap and sell dear. And it had the advantage of running directly contrary to the ingrained and pernicious maxim of Wall Street that stocks should be bought because they have gone up and sold because they have gone down. Alas, after 1949, this formula no longer worked. A second illustration is provided by the famous Dow theory of stock market movements, in a comparison of its indicated splendid results for 1897-1933 and its much more questionable performance since 1934. A third and final example of the golden opportunities not recently available. A good part of our own operations on Wall Street had been concentrated on the purchase of bargain issues, easily identified as such by the fact that they were selling at less than their share in the net current assets, working capital alone, not counting the plant account and other assets, and after deducting all liabilities ahead of the stock. It is clear that these issues were selling at a price well below the value of the enterprise as a private business. No proprietor or majority holder would think of selling what he owned at so ridiculously low a figure. Strangely enough, such errors in pricing these complex deals, they became so good at it that the easy profits disappeared, and many of these desks have been closed down. Although Graham does discuss it again, see pages 174 to 175, this sort of trading is no longer feasible or appropriate for most people, since only multi-million-dollar trades are large enough to generate worthwhile profits. Wealthy individuals and institutions can utilize this strategy through hedge funds that specialize in merger or event arbitrage. The Rothschild family, led by Nathan Mayer Rothschild, was the dominant power in European investment banking and brokerage in the 19th century. For a brilliant history, see Niall Ferguson, The House of Rothschild, Money's Profits, 1798 to 1848, Viking, 1998.
Anomalies were not hard to find. In 1957, a list was published showing nearly 200 issues of this type available in the market. In various ways, practically all these bargain issues turned out to be profitable, and the average annual result proved much more remunerative than most other investments. But they too virtually disappeared from the stock market in the next decade, and with them a dependable area for shrewd and successful operation by the enterprising investor. However, at the low prices of 1970, there again appeared a considerable number of such sub-working capital issues, and despite the strong recovery of the market, enough of them remained at the end of the year to make up a full-sized portfolio. The enterprising investor under today's conditions still has various possibilities of achieving better than average results. The huge list of marketable securities must include a fair number that can be identified as undervalued by logical and reasonably dependable standards. These should yield more satisfactory results on the average than will the DJIA or any similarly representative list. In our view, the search for these would not be worth the investor's effort unless he could hope to add, say, 5% before taxes to the average annual return from the stock portion of his portfolio. We shall try to develop one or more such approaches to stock selection for use by the active investor.